Good morning to everybody on the Rosie Murphy channel, January 31st, 2020. Well, a lot of exciting things going on in investment markets, and quite a few of them ring warning bells with me. But I've had quite a few questions, people asking me about short selling and what exactly does it mean to sell short. I want to do a very simple primer here that might help you understand that comment. For the overwhelming majority of investors, they buy a stock in the expectation that it will go up. And I'm talking about probably 95 to 98% of investors deal in the markets, the equity markets, the stock markets like that. They have an idea on Microsoft that things are going to be changing. Maybe a new software rendition is coming out, and they like the prospects of the company and the way that it continues to develop its software products. Okay? Very, very simple. But few people know that Wall Street can also be a two-way street. Let's not talk about options and things like that. That's another way that you can bet on markets and use what they call leverage, letting a little bit of money exert a leveraging influence and magnify your wins or losses. But let's stay with the concept of selling short. Now, the best way I can give this, the best idea I can give to overview this is it's a way potentially that people make money on the woes of a company. Let's say there's a company, XYZ company, and they believe that XYZ may be potentially going out of business. And maybe they believe that the current stock price of, let's say, $1.25 a share, that this company is doomed. There's no way to escape for this company from Chapter 11 bankruptcy, in which case the stock will go to virtually zero. Now, what they do is they'll go to a brokerage house and say, hey, do you have any XYZ stock that I can borrow? And the company says, oh, well, the brokerage house says, well, okay, sure. We have some XYZ. We have plenty of it that's held in portfolios of our institutional investors who are probably pretty sad at this moment. Yeah, we can take that out of our securities vault and we can lend it to you on one condition, that if you borrow 100 shares of XYZ, 1,000 shares of XYZ, 10,000 of XYZ shares from us, you're really borrowing from a holder out there who's holding it in the expectation that it will turn around and go up. Well, sure, you can borrow that stock, no problem at all, okay? We'll transfer it to you. You put down some marginal amount of money. We'll actually credit your account when you borrow that. And if you sell that, we'll credit your account. If you sell 1,000 shares, we'll credit your account $1,025. Okay? But remember, you have to return those 1,000 shares at some point in the future, regardless of what the price is. So Mr. Smarty Pants seller takes those 1,000 shares of XYZ, sells them in the market, gets the credit in the account, the brokerage account for that sale, and their brokerage account is credited for that amount. And XYZ continues to mope along, and maybe fortunes continue to get worse and worse and worse. And instead of being $1.25 a share, maybe 3 months later it's 25 cents a share. Well, what happens then? The Smarty Pants stock trader goes in, buys 1,000 shares of GameStop, returns it, whatever it is. GameStop's been the hot topic. Buys 1,000 shares of XYZ and returns it to the owner of it, who now has a greatly depreciated stock, and the short seller puts the money in the pocket of about $1,000 on that trade. Notice the amount of shares that they borrowed is this amount of shares that they must return. Well, a lot of things can go bad when you're a short seller. Let's put it another way. Imagine you have a friend of yours that has, well, a very precious piece of jewelry, and you think to yourself, looking up the value, you tell your friend, this thing is very overpriced, this beautiful necklace. They've driven up the value to a stupid level on things like eBay or auction houses. Let me tell you what. Let me borrow that necklace from you. I'll go ahead and sell it to you. I'll go ahead and sell it into the marketplace. And then my expectation is that people will realize that this piece of jewelry, this necklace, is not really valuable at all. There's a lot of other copies of that necklace out there. And what I'll do is when the price collapses and people realize this is really junk, I'll go ahead and buy the necklace back, the equivalent or better necklace, and I'll return it to you. Well, you have full faith and confidence that your nice piece of jewelry, your necklace, will be returned, so you don't care what happens with this person. Now, suppose this person sells it into the marketplace, this beautiful necklace, for like $10,000, because they're laughing and thinking this thing is worth $100. Now, here comes the tricky part. Suppose after this person has sold Smarty Pants, has sold this necklace onto the marketplace, some news comes out that, well, the one that was sold, the one that you have, there's very few originals of that particular necklace, and all of a sudden the market starts to go crazy. Oh, these are the authentic thing by Pierre of Paris in 1810, and these things are rare as can be. Now, if you're Smarty Pants, you're starting to panic a little bit because far from the price going down, the price of this necklace starts to climb. Oh my goodness. And Smarty Pants is thinking, I've got to return this necklace to the owner that I borrowed it from to sell it. And now instead of $10,000, now maybe it's climbed up to $15,000. Okay, so I'm already down $5,000 from the time I sold it at $10,000 to the price it is now. And oftentimes happens, I have the displeasure of seeing that price of that necklace climb through auction house deals. Maybe it reaches $25,000. Maybe it reaches $100,000. Well, guess what? I've got a huge problem, okay? I need to return that necklace or its equivalent, okay? Proven equivalent, certified, back to the seller. Well, you can see the problem. Do you have $100,000 to go into the market and buy back that necklace and return to the owner? Well, probably not. So you go into default, and basically you end up in bankruptcy court with that debt eventually being discharged. Well, the same thing happens in markets. Smart people look at the prospects of a company and they say, oh, this thing is going to zero. This company, like GameStop, they're closing stores left and right. Let's borrow these shares from suckers and let's sell it on the market, and at least we'll profit from the ride down. Well, many's a slip between the cup and the lip, right? And as the old fabled investor Daniel Drew was purported to say in the late 1800s, one of the most famous short sellers and one of the most sour people in the history of Wall Street, he who sells what isn't his and pays it back or goes to prison. And very true. Well, we had a whole flock of people come in from Wall Street Bets, a Reddit group on the social media platform. Trading through Robinhood suddenly brought thousands of people into, tens of thousands of people into GameStop, and they began to punish those smart short sellers who thought GameStop was going to nothing. Well, at the beginning of January, what was it? $8, $10, $15 a share. Now it's some $330 a share. Well, the Smarty Pants short sellers are in a bad way. They've got to go back into the market and turn back the equivalent number of shares that they borrowed from the person or brokerage house that they borrowed those shares from to sell them. A very sticky wicket. And every day they've had the displeasure of seeing it rise to 20 to 25, 30, 40, and they're hoping against hope that this run is not going to last long. Now it's up to 75, 100. Now more people are starting to get interested, and they're buying it too because they know that they have the sellers trapped in that particular security. And the further they drive the price up, the more people they're going to ruin on the sell side. And I think at last check, a stock like GameStop has already hurt the short sellers to the tune of some $20 billion. They took a company that was basically worthless and drove it up to $20 billion market cap today. Well, it's a really dynamic situation. There's a lot of unhappy people that sold that stock short, hoping it would go to zero. And now they're faced with the prospects of returning those equivalent number of shares, those exact number of shares, back to the person that they borrowed from. Now you get an idea of why short selling is so risky. So now, because of the run up in the price, a company like GameStop is able to sell additional shares of stock at a high price and use that capital to save itself from utter destruction. I don't know, maybe it'll turn into a widget company or something like that. But that's the risk of short selling, is that you're going against the trend of trying to make what you judge to be a poor company, a company's poor prospects. And in the meantime, people on the inside, the insiders, the managers, the executives, the CEOs, they're fighting like hell to turn around the fortunes of this company. And you're betting against their ability to make that happen. Okay, that's a dangerous prospect. That's why short selling or borrowing something, selling into the marketplace on the promise of returning the same item later, is so risky. Because when a large group of people like Wall Street Bets, the Reddit subgroup, gets a hold and gets the bit in its mouth to run, you don't know how. That thing could go up to 1,000. That thing could go up to 10,000. And a lot of people that sold that short get ruined in the process. Remember, he who sells what isn't his'n pays it back or goes to prison, right? Okay, yes, you can make money when stocks decline, but do you really have the stomach for that type of activity? All right, everybody, there's a simple primer on selling short, selling something that you borrowed into the marketplace in the contracted expectation and legally binding mandate that you return that same item sometime in the future, regardless of what the value is. Hey, I just want my necklace back. Where is it? Well, Houston, we've got a little bit of a problem. Okay. All right, everybody. Thanks so much for watching. Your comments and questions down below. And be careful out there. It can be, sometimes the big wheels get the wheels torn right off of the train. All right. Thanks for watching, everybody. Thumbs up or appreciate it.